unpredictable. I think still in the longer term it will go up. I think in the next 2 or 3 years perhaps the price level will be somewhere between 40 and 60 and fluctuating, but eventually getting closer to the year the 2020, the price would gradually go up to $70-75 per barrel. That's what we estimate, and we have to prepare for that. After that, again, nobody knows. It would continue to increase gradually, or again, it would fluctuate. Nobody knows. I think the important thing here, this is my conclusion, important thing is that we, oil-producing countries and oil-consuming countries, share the information about the future demand and supply, and try to cooperate to prepare for disruption by having a joint oil stockpiling, etc., etc. I think it's time for producing country and consuming country to cooperate with each other. Thank you.
Thank you very much. And with a viewpoint from the United States, and specifically the administration of the United States, Mr. Hochstein.
Thank you, Martin. And I guess I won't start with introducing who I speak for. I'll let the U.S. government be what it is. I'll start with, we're going to talk about price and so on, and what I would start off by I'm not going to say is what our projection for prices are, because what we've learned is projections are usually as good as the length of the conference that they're set in, and if you look at projections for not only price but for the condition of the oil and gas markets, just compare, let's say, 7 years ago, or 6 years ago, or 5 years ago, 4 years ago, we would read those projections with some surprise today. But let me make a few quick points. One is, as Toyoda-san said, there is a change in the geography, and that is who's driving price and who's driving the market, and that's going to be from the OECD countries driving demand to obviously the non-OECD led by Asia driving the demand for both oil and gas in the coming decades. And that's a change on the consumer side, on the demand side. The supply side, though, has changed quite a bit over the last few years, and some in expected and mostly in unexpected ways. We've seen somewhat of a democratization of the oil markets, and because while production was controlled by a known and limited number of countries, we've seen a great change, and we've seen new countries with new technologies coming online, and specifically the United States clearly has made a big significant change from importing over 60% of our oil to importing less than 30%, seeing a rapid growth of over 2 million barrels a day, but a market reaction of 3 million barrels a day, because with efficiencies in the system across the U.S., we're consuming less than we were. So we are doing more with less today than we were just a few years ago. But the change that I'm referring to is not how much oil we're importing versus exporting, because that would be just dislocation. I think the change really is in what it's forced is how to think about the market. And if you look at the beginning of the price dislocation or reduction in price that started in last summer, summer 2014, or the fall, the first reaction of the media, the press, was, okay, when is Saudi going to cut production, and by how much? It wasn't even the humility of asking the question whether Saudi was going to cut production, but rather when is it and by how much? And it was not understanding, I think there was a misunderstanding still that this was the old type of conversation. We're in a new conversation. And that is, and you know, as you now, we've had time to adjust to this and to think about it more. First of all, we've seen that some OPEC countries have actually increased production rather than decreased production, because if you look at the lessons from the mid-1980s, the late 1990s, cutting production doesn't necessarily yield the result that the textbooks talk about. And sometimes you get a reduction in price even after a cutting of production. But second, as the price comes down, you have to think about what are the dynamics of increasing price, and that is there's geopolitics as part of it. But people like to talk about geopolitics more than they like to talk about the supply and demand, which I think that our friend from Statoil actually accurately reflected that is still a fundamental part of how oil markets are supposed to work. But if we talk about a reduction in American production in shale, in the tight oil, then what happens when price increases? Now, what we've seen in the U.S. is that despite a tremendous price decrease, the reduction in actual production has been smaller, more anemic than originally anticipated. But that's has been largely because the resilience has been there as a result of better efficiencies in the system, reduction in cost in production, changing of how one does things, M&A activity. Cash has been cheap, which has been driving a lot of this, but adjusting to that as well. So there's going to be a decline in production, but by lower number of barrels. And then the question becomes, but if price does go back up, as was suggested by both the previous speakers, price will go back up, but to how much? And at what point does the tight oil boom in the United States go up again? And I'll end there with, that is the point of the democratization. It's no longer a decision by a specific ruler, head of state, who will make a decision that due to domestic reasoning or political reasoning, one should cut production or increase production. But rather the market will make that decision. As if prices go up further than just a few dollars and it gets to the point of that tipping point in the US, shale is onshore, it's tight, it's easier to increase faster, and there can have a market reaction that is faster than the offshore or some of the conventional plays. So that introduces, in my point, if you talk about a turning point in oil, if you think into the future, this is a really, philosophically, this is a very big change, and that'll have real-world applications in how we look at it. The shale gas that is associated with the tight oil has had similar changes of the U.S. going from an importer to an exporter this coming year, but is also creating and accelerating the factor of the delinkage of oil and gas. And as we think about in the coming months, if oil prices do go up, does that re-accelerate again a delinkage of oil and gas? And therefore, in my mind, one more turning point for oil of how it impacts the overall markets in both oil and gas, and which will have the knock-on effects of affecting coal prices and affecting integration of renewables and price and so on. So as you said, Martin, at the beginning, there's not one turning point, there's many, and I've touched on only a few, and I think there are several others to be explored. Okay, thank you. Well, I think those are three very, very provocative, really, opening statements. I'd like to thank you all for getting in so much in such a short period of time in each case. I think that from the opening statements, the way I'd summarize it, at least from a price perspective, is that the panelists seem to agree that the short-term prices will stay low, and that in the longer term there's the possibility for a big growth in price again. So rather than getting into sort of questions of market timing, what I'd like to do is maybe touch on some of the underlying drivers, and specifically the cost structure for producers, and the impact that will have on reductions in supply and potential increases in supply. So maybe we can pick that up as a theme and pick up the question which has also come up from the audience as to how producers are adjusting to the new environment. Mr. Anfinsen, would you like to take that first?
No, I'd be happy to. Before we saw this fall in oil price, I think it was an established fact that the industry per se was not yielding the returns that investors expected. So even at $100 oil price, the return on investment was not, to put it that way, satisfactory. So something needed to be done from an industry perspective. We started before the fall in the oil price, as I know many of our peers did as well. now I think what happened to the oil price, in a sense, helped us. We have ourselves reduced costs significantly, and with the fall in prices, you see the industry around us, so the service industries and all the ripple effects further out, also responding very positively to the current situation. So I expect now to see new break-even prices of oil to be 10, 20, perhaps $30 below where they were before we saw the price fall. And I think that is a healthy development, but it takes for the entire industry, in a sense, to chip in.
Thank you. Mr. Hochstein, would you like to tell us what the marginal cost of production is in the U.S. shale oil sector?
Of course, I'll give the exact price for the tipping point. Just I want to give everybody a chance to record it. I think what was just said is exactly right. At $100 oil, at $110 oil, it is very difficult for companies to announce big cost-cutting measures while announcing also profits. So profits were there, they were clear, but it's very difficult. And I think like nothing accelerates a process of looking at costs in a very specific way and taking aggressive actions like falling 60% of the commodity price. And that's created, I think in the United States, a little bit different because we have the conventional oil production as well as the tight. And I think the unconventional has had to, we don't know the answer. And, you know, I was here at this very conference last year, and I did a TV interview while here in Singapore, and I was asked, what is the tipping point for US? And I said, if you listen to experts on TV, it's $10 below whatever the price is right now. And because when it was at $100, everybody talked about, well, 80, 85. But as it got down, it was always at 90, it was 80, at 80, it was 70, at 70, it was 60, et cetera. Because there isn't a number. And there are different considerations that go into price, cost of production. One is the actual cost of production. The second is the cost of cash. And the cost of cash for the tight oil boom in the US was almost nothing. And that fueled an industry without a lot of relativity to real capital. And we're now seeing all of that play out. There's been a forcing down of where the costs are coming from. So if you look at the service companies, they've taken a very big hit as a result of this, and to some degree more, in a disproportionate way to the actual producing companies. But everything I hear, when you look at the actual producers, and we have over 4,000 of them in the United States, is that their costs are significantly below where they were 8 months ago. And that they still see a movement of possible reducing costs even further. So it's also uneven. So there's no one price in the United States for unconventional oil production. We're seeing prices in different companies, different producers have very different prices. They've had different or a variety of success rates in reducing costs. And those who will reduce the costs the most and will have restructured their financing, who have hedged in a more lucky or smarter way long term, will be able to survive this era and continue on. There's another price point that is important to look at, which is the cost of shutting in. And you could be at below cost of production, but still higher than shutting in price, which will give you a delta period of time of playing there where it's not ideal, you're not making any money, but it's costing you less than shutting in. And so as you take all these factors in, I think that is the reason why the resilience has been stronger. I'll just end on the conventional side. I think that it's refreshing to hear from a producer that talks about the fact that there's still more cost to come down, because for the last 7 years, as we've been in relatively consistent high prices, what we've heard constantly is all the new oil coming onto the market is going to have to come from much more expensive oil, deeper, further out, more complex. But I think part of that has been that the industry hasn't been forced to take a deep look and a hard look at what those costs are and how to bring them down. So I think we are going to see some of that lower. So I'm more optimistic about avoiding overly high prices in the future as we balance the market.
Thank you. Toyota-san.
From the standpoint of consuming countries, the problem is sometimes price goes up too high compared with the production cost. I think if we go back to 1970s and try to have an overview, you would have two mountains like this. The first mountain, I mean, the price hike took place because of two oil crises. And what happened is that non-oil OPEC producers would come in to the market. And because of that, the price went down. There was the first reverse oil shock. And then stayed there for a while. And then it went up because of the Asian economies grow and also geopolitical problem in Middle East, and it went up too high and compared with the cost. And then high cost, at least higher cost non-traditional oil came in. And the second reverse oil shock happened. This is not good for consuming countries. If it is sustainable, I mean, the low level price is sustainable, we welcome that. But if it is not sustainable, we don't necessarily welcome this volatility. I think the important thing for us now we have two reverse oil shock. And so the important thing for us is that somehow we would avoid such an unnecessary price hike on the basis of cooperation between oil producing country and consuming country, and try to have more stable price trend. And we welcome non-OPEC oil, we welcome non-traditional oil, clearly, but the problem is volatility. I think volatility is not good for oil-producing country as well. And so I really like to emphasize that the oil-producing country, consuming country, cooperate with each other, sharing information, and try to avoid unnecessary price fluctuation. And so the role of IEA is quite important. The role of OPEC is important, and the role of IEP is also important. I think more communication between consuming country, producing country, and try to shield the sort of future oil price and demand supply situation. That's quite important.
Okay, Mr. Amferson.
Just a very quick comment to confirm that. I think we don't like very low prices. What we like even less is extremely high prices. That will kill our business before the lower prices do.
I mean, maybe just picking up a couple of the themes which have already come up. One of those has been the availability of capital to the industry, and the large amount of capital which was available, which helped drive the growth in production in the US. And some of us have been around long enough to remember that at the beginning of the oil boom, there was a skill shortage, and which had grown through the lack of development and the shortage of capital prior to that, which is obviously a function of the volatility of prices that you speak about. So maybe would each of the speakers like to talk about what they see the availability of capital is, and whether we're storing up a long-term problem now through the low prices and the reduction of capital available to the industry? Would you like to go first?
I'll listen to the producers first.
Well, we say half jokingly that we've got a lot of money, but we're not rich. So we're in a situation, we've been in these downturns before. We know that it's a cyclical business. So what we do is we batten our hatches, if you will, and ride through it. That means that we do hold back on capital expenditure. We do hold back on expenditure generally now, but that doesn't mean that we shelve projects per se. What we typically do is we take the time we need to mature them into more cost-efficient projects. So we do expect that most of the projects that we have now deferred will reappear at much more healthy break-even prices in a few years' time. And so we will therefore be ready to take the upturn if or when it comes with a much leaner cost base.
Thank you. Toyota-san.
Well, as a person from the consuming country, I think it's important for consumers to share the risk with producers, which means a sort of equity sharing is important. I think now Japanese companies are trying to share the equity, and by doing that, not only in the area of oil, but also in the area of gas, Japanese companies trying to go to the upstream and try to share the equity. And by doing that, I think probably the risk of limited capital can be somehow overcome. And also, it would share the risk by both producing and consuming country. And that's another kind of cooperation between two sides.
Thank you. Mr. Hochstein.
Well, I think, what happens when you have the kind of dramatic reduction in CapEx that we've seen over the last few years, if you take the total of the $200+ billion taken off the market by the sector, I think, as was said, it doesn't mean that all projects go away. It means that the most cost-effective, cost-efficient, ready-to-go projects proceed, and the riskier ones have to wait until a better price environment. It means two things. One, that less oil will come on quickly, which means that the oil markets are doing exactly what they're supposed to and designed to do, and what helps them fluctuate and what makes oil oil markets, people say, they're not stable. They're not designed to be stable. So when prices are low, less investment goes in. It takes a long time to produce, to go from a green field to actual production, to first oil, and therefore that cycle allows it to cycle out. But at the flip side of it also means that the projects that do come online, when that oil comes online, won't be that expensive oil. It's going to be a much more cost-effective oil, and therefore will be supportive of a rational price, of a market price, versus going everything online at the same time, including very expensive oil. This helps for distorting the market. So again, the price collapse allows for a certain rationality into the investment side as well as the other parts of the market.
Thank you. We have a big red light in front of us saying that time's up. There have been several questions from the audience about where prices will go. So maybe we can conclude. I'd ask each of the speakers just to give one price prediction for where Brent crude oil prices will be in 1 year's time. I should say, so we don't let Mr. Hochstein off the hook, that these will be purely personal opinions and not representing their organizations or governments. Would anybody like to have a prediction? Brent crude oil prices in 1 year's time, Mr. Afterson.
For fear of making a forward-looking statement, I believe in the market. I think the forward prices you see is a fair reflection of where you would expect prices to be in 1 year from now. I have no better guess than that.
Okay. Toyota-san.
Well, as I said at the beginning, we think there will be a fluctuation even in the next 2 years. And it's 1 year time, somewhere between 40 and 60. Even within a year, I think there is a fluctuation.
Okay. Mr. Hochstein, personal view?
I'm going to chicken out anyway. And first, it sounds rational to me to what Mr. Toyoda-san has said. However, I started the session by saying that I think projections are meaningless, and I still think they are. And because we know the known knowns, the known unknowns, and then there's the unknown unknowns. And between the supply demand as well as the geopolitical, I will just say that nobody predicted shale or tight oil. And will we have a new technology that emerges in the next 2-3 years? Will the existing technology emerge somewhere outside the United States? If it does, it will be another game changer for oil prices, and all projections now will be out the window.
Well, that was an elegant dodge, anyway, of the question. So, with that, I'd like to thank all the panelists for a very stimulating discussion. Thank you.
Thank you very much, Martin. And again, I'd like to invite our group right now, stage front, for that group photograph. Now, ladies and gentlemen, we will take a short break at this point in time. We'd like to mention to you that this break is brought to you by DNV GL. There are light refreshments and light snacks prepared for you at the foyer. Feel free to have your plates filled and bring them in, if you will, to have some space to sit down and relax before we bring about our final session for the day.